Hey everyone, welcome back to the channel. Today, we're diving deep into one of the newest YieldMax ETFs making noise, PLTY, the YieldMax PLTY Option Income Strategy ETF. Is this ETF a smart way to earn high income from Palantir stock, or is it too good to be true like some critics claim? By the end of this video, you'll know how PLTY actually works, what kind of returns and risks to expect, and whether it fits into your income investing strategy. Let's get started. Hello viewers, if you are enjoying this content and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. Let's unpack the income engine behind PLTY. The ETF sells covered calls, or more precisely, synthetic covered calls, on PLTR's stock. That means it earns option premiums every month in exchange for limiting upside potential if PLTR's stock price rises too much. In simple terms, you earn consistent income but you give up some growth. YieldMax's goal is to turn PLTR's volatility into cash flow. So, when PLTR swings up and down, as it often does, PLTY profits from those option premiums. It's perfect for investors seeking cash flow, but not ideal if you're hoping Palantir's price will skyrocket. Because remember, covered call ETFs typically underperform during big rallies. Now, let's talk income, the main reason people are eyeing PLTY. Most YieldMax ETFs have shown annualized yields between 40% and 70% depending on market conditions. That sounds incredible, but it's not a guaranteed payout. These distributions fluctuate monthly based on Palantir's stock volatility, option market pricing, and fund manager adjustments. If PLTR volatility spikes, income can soar. If volatility fades, income drops. Recent YieldMax ETFs have paid monthly dividends ranging from 3% to 6% per month, but sustainability depends on market conditions. So yes, the yield looks massive, but the underlying price risk could offset it. Now it's time for the fine print, because no investment is all upside. Synthetic exposure risk. PLTY doesn't own PLTR shares directly. It uses swaps and options. If markets move fast, tracking errors can happen. Capped upside. If PLTR doubles, PLTY won't. You'll get income but miss most of that growth. Tax complexity. These ETFs often generate short-term capital gains rather than qualified dividends. Volatility dependency. High income relies on volatility. If PLTR stabilizes, distributions can shrink quickly. Liquidity risk. As a newer ETF, trading volume and spreads can fluctuate. So yes, those huge yields come with strings attached. It's not a scam, but it's definitely not a free lunch either. How does PLTY stack up against the rest of the YieldMax lineup? Investing in Ulti means navigating the volatile landscape of Tesla, balancing potential rewards against significant risks. In conclusion, success with Ulti hinges on understanding Tesla's unpredictable nature and making informed decisions that can either lead to remarkable gains or substantial losses, ultimately shaping your investment journey. Coney is often affected by market fluctuations. Despite its unpredictable nature, Coney's relationship with the cryptocurrency landscape underscores the inherent risks and rewards that come with investing in digital assets. Understanding these dynamics is crucial for navigating the fast-paced world of crypto trading effectively. MSTY finds itself riding the waves of the Bitcoin surge. As the market shifts and volatility increases, MSTY is poised to leverage its insights and technology, ensuring it stays at the forefront of this digital currency revolution. The journey only begins here, promising exciting developments ahead for both investors and enthusiasts alike. NVDY showcases impressive financial stability and consistent technology engagement. NVDY stands out as a solid investment option, combining robust income potential with reliable exposure to the technology sector. Its strategic positioning and performance highlight its reliability in an ever-evolving market landscape. Investors can have confidence in its future trajectory and growth prospects. PLTY sits somewhere in the middle. Palantir is volatile but also has long-term air potential. That makes it appealing for investors who believe in PLTR's story but want monthly cash flow rather than waiting for capital appreciation. Let's imagine three possible futures for PLTY. Bullish scenario: Palantir stock rises sharply. PLTY's upside is capped. Income remains strong, but total return lags. PLTR sideways scenario: PLTR trades in a range. PLTY thrives. Maximum option income. Investors enjoy high monthly cash flow. Bearish scenario: PLTR drops significantly. PLTY's NAV declines. Income might help cushion losses but not eliminate them. The sweet spot: a volatile but range-bound PLTR. That's where PLTY shines. So, is PLTY too good to be true? Not really. It's a high-risk, high-reward income product, not a scam. It can be smart if you understand the trade-offs. You want income from volatility. You don't need massive capital growth. You can handle fluctuations and risk. PLTY could be a powerful income supplement in a diversified portfolio, but not your entire strategy. To wrap up, YieldMax's PLTY ETF is an innovative way to turn Palantir's volatility into income, but like all YieldMax funds, it's not for the faint of heart. If you're chasing monthly cash flow and understand options-based ETFs, PLTY might be worth exploring. If you prefer steady growth, maybe stick with traditional dividend ETFs like SCHD or VIG. Thanks for watching. If you found this breakdown helpful, hit that like button, subscribe, and let me know in the comments, would you invest in PLTY for income?